Hi, I am Ranjith Kumar. In this video I am introducing a new indirect taxation concept named Refundable Tax System. For further queries please email refundabletexsystem@gmail.com. In the modern world, the indirect taxes take an essential part of government's tax revenue. Various countries are following various types of indirect taxations, like sales tax, value-added tax and goods and services tax. In this situation, I am introducing a new indirect taxation concept which I have named as Refundable Tax System. I have written this concept to fulfill the purpose of indirect tax, as well as to create awareness of indirect tax among people, and also enhance the people's life by way of refund of tax. Refundable tax system is based on single point tax, which levied on a product is fully paid at the point of finished products come out from manufacturer. This tax can be claimed and refunded to manufacturers and traders in certain percentage by submitting proper returns, and the refunded tax amount will be distributed to their workers equally. Refundable tax is a single point tax, which is levied directly on the sale value of a product, that is before trade discount. This taxation introduces new ledger accounts, which help to maintain books of accounts are as follows. The new ledger accounts: refundable tax input account, refundable tax output account, tax reverse discount account, own risk rebate account, refundable tax collected account, tax expenditure account, profit reserve account, tax expenditure reserve account. The refund of tax is calculated on sale value, that is, before tax reverse discount, for the purpose of getting tax refund. This concept's main theme is getting refund from tax and distributing the refunded tax to the company's workers equally. The manufacturers, dealers and retailers who deal with manufacturing and trading only can claim the refund of tax. The refund can be claimed from the amount of input of the tax. Usually the discount on product will be deducted on the product value, after which the sale tax or VAT is calculated. In this concept, the refundable tax will be calculated on the product value, after which the discount, that is, tax reverse discount, will be calculated. While claiming the refund of tax, the discount input is directly deducted from the product value, after which the actual refundable tax will be calculated, and the difference between the actual refundable tax and refundable tax paid will be refunded. The process is explained below. The refund of tax is calculated into steps. Step 1. As per invoice. Purchase 10,000. Refundable tax at 10%. 1,000. Subtotal 11,000. Less. Tax reverse discount at 5%. On purchase value 500. The total 10,500. Step 2. As per returns. Purchase 10,000. Less. Tax reverse discount at 5%. On purchase value 500. The tax reverse discount value should be what the manufacturer received. Subtotal 9,500. Refundable tax at 10% actual or calculated 950. Refundable tax at 10% paid 1,000. The difference between actual and paid 50 will be refunded. The following illustration helps to understand this concept and its implementation in books of accounts, and also the impacts or changes in the way of maintaining the books of account. Opening stock and reserves 15,000. RFT at 10% 1,500. Subtotal 16,500. TRD at 10% 1,650. Total 14,850. Purchases and reserves 17,000. RFT at 10% 1,700. Subtotal 18,700. TRD at 10% 1,870. Total 16,830. Grand total 32,000. 3,200. 35,200. TRD at 10% 3,520. Total 31,680. Transferred to manufacture. From opening balances. Stock 7,500. RFT at 10% 750. and TRD 825. From current purchases, 9,000, RFT 900, subtotal 9,900, TRD 990. Total transfers, stock 16,500, RFT 1,650, subtotal 18,150, TRD 990, total 16,335. Closing stock and reserves, stock 15,500, RFT 1,550, subtotal 17,050, TRD 1,705, total 15,345. Note: margin of profit 15%. Total manufacturing cost 7%. On stock used to manufacture. Tax reverse discount 10% on product price. Refundable tax 10%. Prepare. Refund workings. Stock transfer to manufacture workings. Non-gross profit trading account. Trading. And profit and loss account. Refund calculation. Step 1. As per invoice. Purchase 17,000. Refundable tax at 10%. 1,700. Subtotal 18,700. Less. Tax reverse discount at 5%. 1,870. Invoice total 16,830. Step 2. As per returns. Purchase 17,000. Less. Tax reverse discount at 5%. 1,870. The tax reverse discount value should be what the manufacturer received. Subtotal 15,130. Refundable tax at 10% actual or calculated. 1,513. Refundable tax at 10% paid. 1,700. The difference between actual and paid 187 is refund of tax. Tax calculation. This refundable tax system is based on single-point tax system. This concept processes the calculation of refundable tax directly from the sale value or purchase value of a product, after which the discount is deducted. It fulfills the object of levy of indirect tax on a product. It has been explained in the below example. In case of manufacturers, the RFT output on finished goods cannot be set off with the RFT input that is from purchase, because the manufacturers produce new products. Tax reverse discount. The tax reverse discount is maintained in a separate ledger account as dealers and as retailers. Profit, as well as manufacturers. It prevents from the profit of concern as invisible. In this concept, the sale value cannot be reduced by discount, but the TRD has power to reduce the sale value only for claiming purpose to get refund of tax. It is explained in the below example. In case of manufacturers, the TRD takes place into different roles. That is, tax reverse discount input as income, and tax reverse discount output as expenses. Profit reserve. This concept introduces profit reserve feature. It is calculated on the basis of closing balance of tax reverse discount input, proportionate to the closing stock value. In case of manufacturer, the claimed TRD set off with the TRD utilized for raw material taken for manufacturing is the profit earned. It has been explained in the below example. Refundable tax claimed. The refundable tax claimed is treated as tax expenditure, and the value derived from the proportionate stock is used to manufacture. The closing balance of RFT claimed is treated as tax expenditure. The process is explained below. Reserves calculation. Opening stock 15,000. Add. Purchases 17,000. Total stock value 32,000. Stock transferred to manufacture 16,500. Refundable tax claimed 1,650. As tax expenditure. Total 18,150. Tax reverse discount used. 1,815. As discount earned. Closing stock. Refundable tax. Proportionate to closing stock 1,550. As tax reserve. Total 17,050. Tax reverse discount 10%. 1,705. As profit reserve. Accounts with inventory. The major benefit of this refundable tax system is accounts with inventory. In this concept, The manufacturer can prepare two types of trading account. One is non-gross profit trading account, and the other is trading account with gross profit. The non-gross profit trading account processes the raw materials transferred for manufacturing without any value difference. The purpose of preparing non-gross profit trading account is to find out whether the stock transferred to manufacture is at the same value or not, and also to prevent from the manual value adjustments in closing stock. The trading account with gross profit is prepared after the finished goods sale take place. It has been illustrated below. Opening stock 15,000. Purchases 17,000. Total 32,000. Stock transferred to manufacture 16,500. And closing stock 15,500. Total 32,000. Margin of profit calculation. Stock used to manufacture 16,500. Manufacturing cost 7% 1,155. Tax expenditure 1,650. Total 19,305. Less. Profit used TRD 1,815. Total 17,490. Margin 15% 2,623.50. Total product value 20,113.50. Fixed selling price. Refundable tax system suggests fixed selling price of a product. The price of a product remains the same till handed over to the end user. This concept ensures the stability in product price till final consumption. If a manufacturer fixes a product price, it will not change. Manufacturer to dealer. Sale value or product price 20,113.50. Refundable tax at 10% 2,011.35. Total 22,124.85. Tax reverse discount 10%. 2,212.49. Total 19,912.37. Dealer to end user. Sale value or product price 20,113.50. Refundable tax at 10% 2,011.35. Total 22,124.85. Own risk rebate at 5%. 1,106.24. Total 21,018.61. Own risk rebate. Own risk rebate will be applicable only when a retailer or dealer or manufacturer sells their products to the final user. Own risk rebate has no power to get the refund of tax. Trading account with gross profit. Opening stock 15,000. Purchases 17,000. Sales 20,113.50. Closing stock 15,500. And the gross profit is 3,613.50. Trading account with gross profit is only applicable to manufacturers because they are manufacturing a new product and it comes to the market as new product. Profit and loss account. Expenditure side. Tax reverse discount output 10%. On cost value 2,212.49. Manufacturing cost 7%. 1,155. RFT claimed 3,200. Less. RFT reserve 1,550. Net 1,650. Income side. Gross profit brought down 3,613.50. Tax reverse discount input 3,520. Less. Profit reserve 1,815. Net 1,705. The net profit is 411.01. Let us see the features of this concept. Non-gross profit trading account. The first feature is maintaining accounts and stock. In my concept, we can easily maintain the stock because the difference between purchase and sale will be the closing stock, and as usual accounts but without gross profit. The non-gross profit trading account suits to trading companies because there is no need of gross profit. The trading companies are simply dealing with purchasing finished products and selling the same In between these transactions, there is no need for gross profit. Account with inventory. This concept helps to maintain accounts with inventory. In the present procedure, the stock can be maintained manually, and chances to change the closing stock value as per own wish, but this is not possible in this concept. Proper returns and maintaining books of accounts. This concept ensures the manufacturers, dealers and retailers to maintain accounts properly. Only proper maintenance of the books of accounts and proper returns filing is the only way to get refund of tax. Income other than salary. This concept major benefit is an income of other than salary to the workers of the company, by equally distributing the refunded tax to workers. Avoiding tax evasion. Government's income will also increase in this concept, because the tax is collected in a single point, wherein dealers and manufacturers have to show accounts for refund of tax. If they failed to show accounts or improper accounts, the government cannot refund the amount to dealers and manufacturers. It increases the government's income and reduces chances of tax evasion. All the necessary taxes are paid when a product comes out from after manufacturing to the market. Prevention from invisible profit. It helps to maintain income ledger, that is, tax reverse discount input separately, neither by difference in purchase and sale. In financial accounting, the profit could be derived from purchase minus sale, and the difference is treated as profit or loss. But this concept, it maintained in tax reverse discount ledger. It prevents from invisible profit. Manually adjusting the closing stock to decrease the profit, also not possible in my concept. The refundable tax can be claimed and refunded to manufacturers and traders in certain percentage by submitting proper returns, and the refunded tax amount will be distributed to their workers equally. Thanks for watching this video. My next video, methodical business booking, a new method to maintain books of accounts, especially for manufacturers. Please email to get the PDF copy of my concepts, refundable tax system, and methodical business bookkeeping. Refundable tax system at gmail.com. Methodical business book at gmail.com. Thank you once again.